Mabang, ladies and gentlemen. I'm Hiral Datia. We have with us Ms. Keta Kurkute, ED at United Financial Consultants, joining in. Welcome to the show, Keta, and a pleasure to speak to you and get insights from you today.
Yeah, thank you so much, Hiral. Thank you.
So to start off with, Keta, what we're seeing right now in terms of where the Indian rupee goes, we've almost shed around 4.3% against the dollar in this calendar year. But interestingly, we've advanced by almost 6.5% against other major global currencies. What is this actually alluding to you accordingly?
You have rightly said we have depreciated against dollar, but vis-a-vis other currencies, especially G7 currencies, euro, pound, we have appreciated. Mainly this main reason behind rupees appreciation against non-dollar is RBI's intervention. If you look at the currencies which have fallen vis-a-vis dollar, especially euro, pound, the currency is depreciated phenomenally. Means euro has come down by almost 6.5%, pound by 7.5%. But if you see rupees depreciation has been quite slow, mainly on account of RBI's intervention here. Rupee should have traded above 78 if RBI was not there in the market. So RBI has slowed rupees depreciation. Because of that main factor, rupees fall has been restricted against the crosses. On the contrary, against the crosses, for example, against euro, we have seen euro depreciating big time against rupee. So the main reason for this is RBI's intervention in controlling rupees fall against the dollar.
Right. And overall, if you see now from here on, the clear focus that the RBI is alluding to with their actions is containing and prioritizing inflation management.
Absolutely.
And with that, if you go to see clearly, as you mentioned as well, their intervention strategy has been aimed at arresting the rupee slide and minimizing the impact of imported inflation as well.
Right.
So how do you see this moving from here on?
See, yesterday in our governor's interview, he has given a very clear indication that RBI would be there in the market. They are there to control the volatility. And with RBI's focus now shifting from only growth to controlling inflation in line with other central bankers, India being a developing nation, India being having a higher imports, imported inflation will always be a concern. So they will try their best to control rupee falling beyond a certain level. More or less, they will try to keep it in a range for the remaining part of the year also, Hiral. Because to control inflation, you have two tools. One is interest rate. To control inflation, money supply is important. They are taking care of it. Interest rate, after a point, you just cannot hike the interest rate very fast because that will cripple the economy. So the third best tool that they have is forex reserve, and they will use it in a very optimal way, and they will try to keep rupee in a band and avoiding any disruption. You might not see a big appreciation in the rupee unless we see dollar index falling and the threats of recession hitting the US economy and markets moving again back from dollar to non-dollar assets. But definitely the depreciation would be quite slow. We will see a range bound market. Even if you look for last 1 week's time frame, dollar index has come down from 105 to 103, sub 102. But rupee is in a range bound market. Means you are seeing rupee between 77.50 or 45 to 77.65, 70. Only 30 paisa movement since last almost a week. So what RBI is doing best is, if you keep rupee in a range, I think so here a lot of companies in India can adjust their positions. A sudden appreciation or a depreciation is something which is not advisable or not adjustable at this point of time.
Right. So from an emerging market perspective, if you have to see, Keta, you have a US rate hike, which is fast. FI outflows are also huge. Commodity prices have gone up. There is overshooting inflation, and that's actually urging central bankers to go for a rate hike and compromise on the growth.
Right.
Leaving this apart, if you talk about the trade deficit, fiscal deficit, that's also widening on a month-on-month basis.
True.
Now, In the last 1.5 months, you have emerging market currencies which have depreciated. Rupee itself, if you see, was outperforming in the month of April, whereas in the month of May is when the depreciation has actually started. So, are we saying that in spite of this depreciation, we are not going to see further pressure in the short to medium term, and the RBI will continue to maintain it in the range despite of all these challenges?
Absolutely, absolutely. See, usually whenever a reserve bank or whenever a central bank mops up reserves, the main intention of mopping up reserve is for such kind of scenarios only. When you see a runaway or such kind of an unprecedented markets where nobody knows, we are in a war like a situation. You rightly said commodity prices are moving higher. Nobody knows. One day oil is low. After a week again oil prices rises. So this is something which is a totally unpredictable kind of a market. And reserves 1 year or 2 years back we were at 400 plus. Today we are close to 600. So such kind of reserve accumulation is only done for such kind of a situation where RBI should be in a position to manage the country from such shocks. So you have rightly said what I personally expect, or as a team we expect Rupee RBI to be there in the market aggressively. They will try to manage the rupee. They will give an interest rate hike, but vis-a-vis that they will also try to intervene in the market time and again, and they will slow the pace of the rupee's depreciation. If things change after 2 or 3 months, if we come out of some kind of a war situation, or if there is something, so that will again give a lot of boost to emerging markets. So if you look at emerging market currencies also, CNY has come down from close to 6.8 levels to we are seeing at 6.65 levels. So there is sharp appreciation in that CNY as well. So such kind of a sharp movement is something dangerous, which RBI, I think so, they are not comfortable with it. So they will be there in the market and they will try to keep the market in a range bound, make it 2 rupees or 3 rupees, but they will not allow rupee to go, out of hand where it will be difficult for them to control on all the sides, stocks, bond, as well as forex. So they will try to intervene in the market going forward also.
Right. So with this said and done, I was just reading a couple of IMF forecasts as well, where they're expecting India's normal GDP to grow at around 13.4% in FY23 in rupee terms. And in dollar terms, I think it's somewhere in that range of 8.2%. Yes. Now, if you see the difference between the two nominal growth rates, it's down to the change in the exchange rate. While, with the rupee seeing depreciating to almost 81.5 per the dollar in FY23 from a 77.7 per dollar in FY22. So that was an interesting, mathematics that I was seeing as to what is that normal GDP that they're expecting from FY22 to FY28 and what's that implied exchange rate, which tells us that probably it could go to levels of almost 94.4 in FY28. Do you think that's something which is really realistic?
No. I personally feel, giving some prediction on the currencies is something, it is even God cannot give you that, because there are so many factors which influences an exchange rate. It is mathematically you can go to any exponential rate. If you look at rupee depreciating every year close to 4.5-5%, if you just factor in that, you would be at 100 also. Every year if rupee depreciates by 4.5-5%, but usually that doesn't happen. Mainly on account of even India is increasing the interest rate. So interest rate differentials, which was in favor of US, will come down, because we are also on now, we are trying to catch up the curve, or even we are trying to increase the interest rates. Having said that, we are a developing economy. We'll always see inflows, a growth story. If you compare our growth or our consumption pattern with the developed nations, we still have a very healthy consumption pattern. So you will see FDI investments, you will see FI investments. There will be corrections in the market. You have to accept that markets are there. You will see outflows as well. But having said that, mathematically coming up at a number and a realistic number, or where there are inflows, is something different. So nobody knows rupee would be, but looking at where we have started from, Hiral, we were at 51 in 2008-2007 levels. So if you look at 10 years trend, even if you consider a technical picture, after a 10 years boom, you will always see a correction in the currency. A rally of USD INR for 10 years, you will see a 3-year period where you will see rupee appreciation. So you cannot time the market from where rupee will appreciate or it will continue its appreciation. But I feel it's a mathematical number. I might not take it fully. I will take it with a grain of salt because India's story is different. Developing nation, you are seeing good consumption pattern. You will see hiccups. That is a sign of a healthy market. A market should not be only one-sided. We need corrections, and that is happening. But definitely 94, 91, something I'm not. We are not comfortable with those levels at this point of time.
Right. And overall, Keta, if you have to see in terms of the range that the RBI will look to maintain, what does that look like, from here on?
Yesterday, governor has made very particularly very clear statement that they are not targeting any rate as such. But looking at the current market and current dynamics of ours with our Asian peers, I think so somewhere between 75 to 78.50. This 3 rupees band is something where even Indian companies are comfortable with. The corporates, they are on both the sides. Even their payables could be hedged at those levels. So a band of 75 to 78.50 is where RBI should be comfortable with. We might not see rupee suddenly hitting 80 and all. You might see a big hiccups and see the entire strategy of raising interest rate to control inflation will get defied. If rupee weakens after a certain point, because you won't be able to adjust crude prices, nothing will happen. So their entire strategy would be defined. So a 75, 78.50, this 3 rupees range should be an ideal range for the rupee under this current market circumstances.
Right. And overall, what is that strategy that you would actually recommend, for the Indian rupee right now?
Indian rupee at present, close to 77 exporters. See, today the premiums are good enough. The premiums we are getting almost a rupee for September, October forwards. So at upticks, one should need to keep, exporters should hedge their receivables, because usually a sudden appreciation of 76, 80, what you lose is your entire premium. So close to the current levels and another 10, 15 paisa up, exporters should take 6 months forwards, 3 to 6 months forward, and importers at 77, 30, 45 dips, they should try to cover their imports for 1 or 2 months, depending on their risk appetite. So see, this year, Hiral, to be very frank, we have started this year with a very subtle pace. Your dollar index was at 96. February 24th, with the war situation, with Russia invading Ukraine, everything has changed. So this year is going to be one needs to be cautious. Neither of the positions, exporters being very complacent, rupee to weak hone wala hai, and we are going to reap the benefits. One should not be complacent, because whenever one-sided market, when you are too complacent, markets will always give you a U-turn. So exporters and importers, they need to be carefully trade to this market, at least till December 22, where things will be clearer on interest rate cycle also, as well as what we are landing in after post-war, or whether this thing continues. So both needs to be careful. Importers should take care of their near-term imports. At every dip, they should try to cover their near-term imports. Exporters should capture the premium and at least keep themselves 30 to 35% hedge.
Absolutely. And I think that's the best advice that you've given us as well today. Thank you, Keta, so much for joining us on the show. It's always a pleasure to speak to you.
Same here, Hiral.
Absolutely. And stay safe and speak to you soon again. Take care.
Soon. Take care, Hiral. Thank you so much.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.